stays offshore, not. I'll be introducing Dennis Brager in just a moment, but first I wanted to talk to you about our MCLE credit that we have available if you're an attorney. Make sure that you sign on to the webinar with your first and last name and your email address, because this is going to be our electronic record that you attended the webinar. And then you can email Eva for your webinar evaluation form, which is necessary for us to keep so that we prove that not only did you attend, but that you evaluate the webinar as well. And this is her email address here. You can also find her email on the invitation that you received for the webinar. And then when we receive your form, we will email you a certificate of attendance that you have to prove that you attended the webinar as part of your MCLE. And we'll keep those records as well. So let me introduce to you Dennis Brager, who's going to be talking about FBARs today. He is a California State Bar Certified Tax Specialist and a former senior trial attorney for the IRS's Office of Chief Counsel. He is the founder of the Brager Tax Law Group, a Los Angeles-based tax litigation and tax controversy law firm. The firm's practice is limited to representing clients having criminal and civil disputes with the IRS, the Franchise Tax Board, the State Board of Equalization, and the Employment Development Department. The firm has advised hundreds of clients on offshore accounts. Dennis is a frequent lecturer at the UCLA Tax Controversy Institute and the USC, and also at USC. Dennis has been quoted as a tax expert by many publications, many national publications, such as Business Week, Accounting Today, and local publications, the Daily Journal, the National Law Journal, USA Today, Money Laundering, and Tax Analyst. He's also appeared on ABC Television's Good Morning America, Fox Business News, and KFWB Money 101, and KABC's The Larry Elder Show. Dennis, welcome.
Thank you. Thank you very much. And welcome, everybody. Good morning. And why don't we get started by, I'm going to explain, very briefly what the problem is, and then we'll go off from there, covering a number of different topics. If you have questions, you can submit them in the chat box. I will try to get to them either as we go along or at the end, depending upon how things work out. Also, if you hang out for the entire presentation, you'll get to find out at the end who won our FBAR contest that we had, and some of the surprise answers. So let's get started. So the problem is that all U.S. persons who have signatory authority over or a financial interest in an offshore account are required to file an FBAR. That form number is now FinCEN 114. It used to be known as TDF 90-22.1. And again, it's for U.S. persons with accounts with combined balances at any time during the year of over $10,000 US. So we have a number of defined terms here. U.S. persons is an important one, and a U.S. person is defined to include a U.S. citizen or a U.S. resident. And the test of what a resident has changed over time, but currently it refers to anybody who's a tax resident under the Internal Revenue Code. Basically, this is the green card test, or a legal permanent resident is considered to be a resident and therefore a U.S. person, as is anybody who has a substantial presence in the United States, any entity, including but not limited to corporations, etc., partnerships, trusts that are formed under U.S. law. That substantial presence test may not apply prior to the issuance of the new FinCEN regulations, not so new anymore, they're about 3 years old. But if you're looking at clients who have not filed FBARs going back a number of years, it may turn out that they were not required to file them prior to the 2011 year. I mentioned that only people who have a financial interest or signatory authority are required to file the FBAR. Financial interest is also a defined term. It starts off anybody who's the owner of record or the holder of legal title on the account. So if your client's name is listed on the account, whether it's their money or not, they are considered to have a financial interest in the account. And then a U.S. person also has a financial interest in each and every foreign account for which the owner of record or the legal title holder is a person acting as an agent or a nominee on behalf of that U.S. person. So if, for example, an account is set up overseas in the name of somebody else, but it's actually your client's money, even though their name is not on the account, they are required to file an FBAR. If your client is the owner of more than 50% of the stock of a corporation, then that individual is required to file their own FBAR. And you have situations sometimes where there are two FBARs being filed for the same account. So the U.S. corporation that is the owner of the account, the record holder of the account, the corporation has to file an FBAR, and the 51% owner of that company, if they're a U.S. person, is also required to file an FBAR. And there are, certain trusts are required to file, specifically if the U.S. person is the trust grantor, that grantor has to file an FBAR, because if they have a ownership interest pursuant to the grantor trust rules, Code Section 671 to 679. As you know, there's a question on the Schedule B which asks, at any time during 2013, did you have a financial interest in or signatory authority over a financial account located in a foreign country? And then it refers you to the FBAR instructions, and it asks a few more questions. And the problem here is that if your client checks the box that says no, it subjects him or her to a possible criminal charge of filing a false income tax return, even if there's no unreported income. It's a false tax return. Granted, it's unlikely to see a criminal prosecution based upon just checking the box no, but it does create additional problems. FBARs are due June 30th. That date is fast coming up. This is the first year that electronic filing is being required. That kicked in July 1st of 2013, actually, but for timely filed FBARs, this is the first year that timely filed FBARs will need to be filed electronically. If your accounting software doesn't handle it and you're going to be doing it on the FinCEN website, I strongly suggest you get a head start on this. It's a tedious process. You've got to register. There are all sorts of issues here. Don't wait until June 30th to start filing your very first FBAR. There are no extensions of time that are allowed to file FBARs. The the extension for filing the tax return is not an extension for filing the FBAR. And one interesting point that it makes sense to bring up at this moment is the statute of limitations for the IRS to go after the FBAR penalty is 6 years from June 30th, even if no FBAR was filed. So it's very different from the income tax rule that we're used to. If an income tax return doesn't get filed, the IRS can assess the taxes at any point, 20 years later if they wanted to. But here the rule is different. And the reason the rule is different is because FBARs are required not under the Internal Revenue Code, which is Title 26 of the U.S. Code, but under Title 31, the Bank Secrecy Act. And that's why you'll find certain places where there are discrepancies between the income tax rules that you're used to dealing with as compared to the FBAR filing rules. Another example is with regard to tax returns, you can always file them by mailing them, by hand carrying them, but here your only option is to electronically file. So what are some of the penalties that can be imposed by the IRS if there's a failure to file the FBAR? Well, if there's a willful failure to file, there can be criminal penalties. The willful failure to file the FBAR is punishable by a fine of up to $250,000 or 5 years in jail or both. If there's a willful failure to file the FBAR while violating, quote, any other law of the United States, then the penalty can go up to 10 years in jail. And if you think about it, when you don't file an FBAR, it's usually at the same time you're checking the box no on the tax return. So you're violating, or your client is violating, another law of the United States, and potentially could be subject not just to 5 years in jail, but 10 years in jail. Now, I've not seen any cases where the IRS has actually gone after this 10-year penalty, but it's sitting out there. I'm not going to, list every possible crime, but another important one is tax evasion. Usually, if there's an FBAR violation, there's an associated failure to report income. If that failure is willful, then there's a potential for tax evasion charges. Now, let's assume for the moment that your client is lucky enough to avoid any criminal penalties. There are also civil penalties. And there are a couple of different tiers of these civil penalties. It starts off with a negligent violation. If your client was merely negligent, then the penalty is up to $10,000 for each violation. The IRS takes the position that if there are multiple accounts, there are multiple violations. Now, I don't necessarily agree with that position. Actually, I don't agree with that position. And there are a number of other attorneys who also don't think that's correct. But in point of fact, there's been no litigation on this issue. So the problem is that, in my mind, a violation occurs when the client fails to file the FBAR. So if the client fails to file the FBAR for 3 years in a row, then the maximum penalty should be $30,000. However, if there are 3 accounts, it's the IRS position that the client would be liable for a $30,000 penalty for each year because there are 3 separate violations. So the penalty could be as much as $90,000. And if you assume that somebody fails to file the FBAR negligently for 6 years in a row, 6 years again being the statute of limitations, then there's a potential, in my example, for a penalty of $180,000 for a simple negligent violation. And I know that we have a lot of clients in Asian countries, and for some reason or another, they have many, many accounts. I've seen as many as 50 or 60 accounts held by one client. And so even if the penalty is, or even if the behavior is negligent, the penalty could be absolutely huge. So what are some of the other civil FBAR penalties? There's the willful failure to file. And this is what everybody is always concerned about, because it's up to the greater of $100,000 or 50% of the amount in the account at the time of the violation. So imagine a client with $1 million in her account. The penalty would be $500,000, and that penalty, again, could be imposed 6 times for each year during the statute of limitations. You could be looking at a penalty that is 3 times the amount in the account. Now, notice here I said up to the greater of $100,000 or 50%. So let's assume a smaller account that only has $100,000 in it. The penalty there could be $100,000, in other words, 100% of the account balance. So these numbers just, add up substantially. Let's go on to penalties imposed under Title 26, the Internal Revenue Code. These are not specifically FBAR penalties, but they're related, and they certainly come up in the FBAR context. So there's the civil fraud penalty for willful failure to report income. That's 75% of the tax due. If it's just negligent, there's an accuracy penalty, 20%. And then we have all of these penalties for failing to file certain foreign information reporting returns. So if the client fails to file a Form 3520 reporting the transfer of funds to a foreign trust, that penalty would be 35% of the amount transferred or received from a foreign trust. And this penalty, as is the case with the next two, doesn't require willfulness on the part of the client. If the client was merely negligent, then these penalties could be imposed. So if the client transferred funds to a foreign trust or received a distribution from a foreign trust, and they didn't let the tax return preparer know about this distribution, there's a chance that the IRS could impose this penalty, because the assumption is that if people should know to ask their tax return preparers or delve into it if they get these distributions. Same thing with a failure to file a Form 3520 to report the receipt of a gift or an inheritance from a foreign person. This is a 5% penalty, but it's 5% per month to a maximum of 25% if the Form 3520 is not filed in a timely manner. And then we have a penalty for failure to report transfers of property to foreign corporations. There's penalties for the failure to file 5471s and 5472s. Generally speaking, these are $10,000 per form. We've got other penalties for failure to file the Form 3520A, reflecting ownership of a foreign trust under the grantor trust rules. And there are penalties for failure to file foreign partnership information returns. A key point here is that there is no statute of limitations on the failure to file the various foreign information reporting forms. So it's the same, it's general income tax rule, not the FBAR, not the 6-year FBAR rule. So we've seen cases where client formed an offshore corporation 20, 25 years ago, and the IRS can go all the way back. Actually, I think most of these information reporting requirements came into effect, if my memory serves me, I think around 1989. So the IRS can go all the way back and assess these penalties on an annual basis. And then, of course, there's always interest. Now, it always seemed like there was this assumption that people who didn't file FBARs were somehow attempting to evade their taxes, they were cheating on their taxes. But what we've discovered over the years is that, in fact, a large majority of individuals who fail to file FBARs are not your traditional tax cheat. So, for example, a client who's a U.S. citizen decides to buy a place in London. He opens an account in England and puts $500,000 in that account. He's going to use that as a down payment. It's just in the account temporarily, but nevertheless, that person is required to file an FBAR. Another example, a client who's born here moves to another country to live and work, and of course, they have accounts in that country. Well, they still have to file an FBAR, even if it's just a checking account. If the balance is over $10,000 on all of the accounts that are held overseas, the FBAR is required. We get a lot of clients who are immigrants. They're born in other countries. They move here, but they still maintain accounts in the country that they're from. Those individuals are still required to, of course, report all the income on that account as well as file an FBAR. And a lot of people who've moved here are sort of shocked to discover that they have these filing requirements. In fact, a lot of them will say, well, wait a second, this is not my money. Yes, the account is in my name, but the money doesn't belong to me. I'm holding this. It's family money, and this belongs to this was money which originated with my grandfather, and my job is to hold it essentially in trust for the rest of the family members and to distribute it on an equitable basis as if and when needed. But that doesn't change the fact that the client needs to file an FBAR. Another one that comes up a lot is Canadian retirement accounts. FBARs are required for Canadian retirement accounts. All right, let's go. We'll go to the next slide, skip over the last example, and go to the question that most clients seem to find very important. How will the IRS find out if I don't go into the offshore program? Is the IRS going to know? And of course, there's FATCA, which is coming into effect very soon. We'll talk a little bit more about that in a moment. Then there are the various IRS investigations that have been ongoing. Of course, Credit Suisse has been in the news recently. They paid a huge fine to the Department of Justice to avoid criminal prosecution. There have been ongoing investigations of Julius Baer, HSBC, Bank Leumi, Basler Cantonell Bank, Bank Hapoalim. I think there are about 10 others on the list of banks that the Department of Justice is actively investigating for possible criminal prosecution. And then we have the Swiss bank tax amnesty. The banks had until the end of last year to sign up with the Department of Justice to obtain non-prosecution agreements. And 106 Swiss banks signed up. The penalties that will be imposed on the banks under that program max out at 50% of the aggregate account balances. And information regarding the accounts held by the bank that existed as of August 1st, 2008 must be turned over to the IRS as part of the deferred prosecution agreement. Now, these banks have sent out thousands and thousands of letters to their customers warning them that if they don't do something, their names are ultimately going to get turned over to the IRS, and the clients are, the individuals are just shocked over this because there's still a lot of people who are totally unaware that these foreign accounts are turning into a problem or have turned into a problem. We get a lot of people coming in who closed out the accounts a few years ago and thought that they had dodged a bullet by closing out the accounts, and now they're finding out that that didn't work. And in some cases, they didn't bring the money back to the U.S., but they moved them into other offshore accounts, and that's creating an even larger problem. So I mentioned FATCA. July 1st, FATCA withholding is supposed to begin. But I think this next bullet point is the most important one for our clients. FATCA reporting of specific account information is effective as to accounts that are still open as of January 4th of this year, and the reports are due to arrive at the IRS no later than March 15th of next year. I don't want to get into the details of FATCA. I think we can skip over that. I think the important point is this last bullet point which is that under FATCA, the IRS is going to the foreign banks are going to be providing the IRS with information about the accounts, and the IRS, of course, is going to be matching that information up. I think those individuals who haven't reported the income are obviously going to be in a lot of trouble. What other ways can the IRS find out about your client's account? Well, there are always whistleblowers. In the past, there have been disgruntled bank employees who've gone to the IRS with stolen information. There are bank employees who have their own problems with the Department of Justice. They're under indictment, and they're trying to scramble to cut a deal. We can safely assume that those people are turning over information about their former customers and clients. There's always the possibility that somebody wants to get a reward from the IRS. So if those people have information, they'll be turning it over to the IRS. And then there's the usual suspects, the X's. ex-spouses, ex-employees, ex-business partners, anybody who your client has revealed the existence of the foreign account to, now is on bad terms with your client, and they are in a position to go to the IRS and create all sorts of problems for the client. Another source of information is the foreign banks themselves. Most foreign financial institutions have closed out the accounts of U.S. persons who refuse to fill out the Form W-9 and agree to report to the IRS. And then there's a number of activities ongoing by the IRS. There was a summons issued to HSBC. There's, of course, the 44,000 taxpayers who've already participated in the OVDP. As part of that process, the clients are required to provide the names of attorneys, accountants, tax advisors, people who assisted them in setting up the foreign accounts. The IRS has created a database. They're going after those people, and in turn, those people will no doubt be turning in the names of the rest of their clients. There are treaty requests that the IRS, that allows the IRS to obtain information about foreign accounts. Keep in mind that Switzerland is really almost a unique situation in the sense that it has very strict privacy laws. Most other countries don't have these privacy laws, and all the IRS basically needs to do is go to these other countries and ask them to use their laws and their taxing agencies to go after individual banks, etc., so that more information can be obtained. So there's, there's a long list here. I don't want to belabor it. Most recently, Swiss Partners entered into an agreement with the IRS. Swiss Partners, by the way, is a Bahamian company, despite its name. And as part of its negotiations with the IRS, it turned over 110 of its clients. So against this rather grim background, we have to look at the IRS's OVDP, Offshore Voluntary Disclosure Program. And the first thing to discuss is who's not eligible. Well, if your client has an illegal source of income, obviously drug dealing, but embezzlement is another common issue. So if that's where your client's money is coming from, then they're not eligible for the OVDP. If they're under investigation by the IRS's Criminal Investigation Division, then they're not eligible. And actually the first one on the list is more commonly a problem. If the taxpayer is under audit, whether or not it's related to an offshore issue, that individual would not be eligible for the OVDP. Just to clarify, if the audit has been completed at the time you submit the request to enter the OVDP program, the client is not disqualified. It's only if the audit is still open. So the OVDP has been going on since 2009. It started out at a 20% penalty. It went to a 25% penalty, and now it's at 27.5%. It's been at that level since January of 2012. The program is open-ended, but the IRS has said a number of times, and it's there in the FAQs, that the IRS could terminate the program at any time. In my view, that's not terribly likely, but perhaps more importantly, they've said that they could terminate the program as to specific classes of taxpayers. So, for example, right now, even though there's an investigation of Credit Suisse going on, and it seems likely that more names are going to eventually be turned over by Credit Suisse to the IRS, even if your client banks at Credit Suisse, they're still eligible to enter the OVDP. But at some point in the future, the IRS could change that and say, okay, if we have an active investigation of a bank, then we're not going to allow you to enter the OVDP. And that's a reason why I think that it's a really good idea for clients who are thinking about going into the OVDP not to delay terribly long, because we never know when things are going to change. In fact, the Commissioner of Internal Revenue Service mentioned a couple of weeks ago that there are going to be some changes to the OVDP program coming out, perhaps as early as the end of this month or the beginning of July. He hasn't shown his cards very much as to what these changes might be. The comments he's made suggest that the changes are going to be favorable to taxpayers, but you know, until we see them, we don't know what these changes are going to look like. So if somebody goes into the OVDP, there's a lot of information that's required to be provided. Things like original tax returns, its amended tax returns are required to be filed, reporting the unreported income. There's copies of bank statements. There are these foreign account or asset statements that have to be filled out and prepared. There's the penalty calculation that has to be prepared. There's a lot of information that needs to be submitted. Now, the other thing that your clients are going to want to understand is that the IRS is going to expect as part of the package a check in full payment of the total tax, interest, and all applicable penalties except the so-called in lieu penalty. That's the 27.5% penalty, which is imposed in lieu of all other penalties. In theory, it's possible to get a payment agreement or an offer in compromise, but keep in mind that the IRS is going to look at that very strictly, and the FAQs indicate that the burden is on the taxpayer to show that they're unable to pay these penalties. And while for many clients it's a financial hardship, it will require sacrifice. The IRS is not terribly concerned about that sacrifice. They're just looking at, whether or not this person has the funds available to pay. And again, I've just got a list here. You can use this, or you can pull it off the IRS's website. There's a great deal of documentation to be turned in. I would focus on this last item that's on this slide. The client is going to be required to sign waivers extending the time that the IRS has to assess additional tax and penalties, including any FBAR penalties. So what are the penalties under OVDP, and how is that calculated? As mentioned, it's 27.5% of the highest account balance at any time during the prior 8 years. And that's true even though The FBAR penalty statute of limitations is only 6 years. Sometimes clients ask, well, how can the IRS assess a penalty based upon a balance 8 years ago when the statute of limitations is 6 years? And the short answer to that question is because a condition of entering into this program is that you agree to this condition. And if you don't like it, then you don't get the benefits of the OVDP. Important to understand that the penalty base on which the 27.5% is calculated doesn't just include the foreign financial accounts that have to be reported on the FBAR, but applies to all of the taxpayers' offshore assets that are related in any way to tax noncompliance. And what the IRS means by that is, let's assume that your client has an apartment building in another country, and they rent out that apartment building, and the rent is not reported on the tax return, on the U.S. tax return. Well, that apartment building would be considered to be tax non-compliant, and therefore the value of the building, the fair market value of the building, less any encumbrances, is included in calculating the 27.5%. And for some clients, that's a deal breaker in terms of going into OVDP and creates a situation where OVDP is no longer a good bet. Okay. In addition to this 27.5%, the so-called in lieu penalty, the client will pay an accuracy-related penalty of 20% of any taxes due. And if there was a late filing or late payment of the tax returns, then penalties could be payable under Section 6651 for late filing and failure to pay. And that relates, by the way, to the original return being late. We're not talking about the amended returns here. In the OVDP program, the taxpayer cannot argue lack of willfulness and say, oh, I should be entitled to the $10,000 penalty that I mentioned earlier in our talk. Again, those are the strictures, the confines of the OVDP program. Nor can the client argue that they had reasonable cause for failing to file the FBARs. These are simply off limits. If the client wants to bring up any of these arguments, then they're going to have to opt out of the program, and I think we'll be talking for a minute or two about that later. Now, there is some relief for non-citizen, non-filers, and actually it's not limited to non-citizens. Actually, that slide isn't correct. It's available to non-filers. So these are people, this is the so-called streamlined compliance procedure, and eligibility is limited to those who have lived outside of the U.S. at all times since the beginning of 2009, and they cannot have filed a U.S. tax return during that period, and they must also present a so-called low-level compliance risk. The benefits are substantial if your client qualifies. Only 3 years amended, original tax returns in this case need to be filed as opposed to 8 years of amended returns under the OVDP. There's no FBAR penalty, no in lieu penalty, no accuracy penalty, no penalties. And the documentation that's required is much less extensive than that list I went through a moment ago. So I mentioned that you also have to have low-level compliance risk in addition to being outside the U.S. and being a non-filer. The IRS looks at a number of factors in determining whether or not there's low-level compliance risk. And the most important one that they're looking at is whether or not the tax due for the prior year is less than $1,500 in each year. Having said that, the IRS has announced that it will consider looking at cases where the liability is higher, but they haven't said how much higher. Even if the tax due is less than this cutoff of $1,500, there's a short laundry list of additional items which will cause compliance risk to rise. And they are, if the returns submitted through the program claim a refund, if there's material economic activity in the United States, if the taxpayer is not tax compliant in his country of residence, if the taxpayer is under audit or investigation by the IRS. These are all factors which could raise the compliance risk. I've got some more, but I want to, the problem is that some of these factors are not subject to easy definition. So, for example, what does it mean to say there's material economic activity in the United States? How much economic activity will be considered material and therefore disqualifying? No simple answers to that question. Some other factors that the IRS looks at, of course, if there have been previously penalties assessed against the taxpayer, they're not going to be a very good candidate. If the taxpayer has accounts outside of his country of residence, that's going to raise compliance risk. If there's U.S. source income, that can raise compliance risk. And, you know, so there's this list of factors, some of which are clear, some of which are not. And the IRS hasn't said that one factor alone will be disqualifying. It's just listed these factors, and it says it may raise the compliance risk. So it's somewhat difficult to tell whether or not somebody is going to qualify for the Streamlined program. So what are the downsides of the Streamlined compliance procedure? I mentioned the upsides. Well, the new procedure doesn't provide any protection from criminal prosecution. So, for example, if you apply for the Streamlined program and the IRS looks at the application and says, no, we don't think you qualify because you, for example, had material economic activity in the United States. At that point, if the IRS were to determine that it was appropriate, they could prosecute the individual criminally. Remember that under the OVDP, one of the most important protections that you get by going into the OVDP is a virtual promise from the IRS that there will be no criminal prosecution. It doesn't come with the Streamlined program. Another big problem is, once again, if IRS determines that you don't qualify, you can't sort of fall back and say, okay, I didn't qualify, I want to go into the OVDP. Nope, you're out. It's not a do-it-yourself project. It still requires a lot of legal and accounting fees to produce all the documents. and most importantly, an analysis to determine whether or not the client has criminal exposure, which makes the streamlined procedure inadvisable, and to be able to compare what's going to happen under the streamlined compliance procedure to what would happen under the OVDP, and to see if it's worth the risk of attempting to go into the streamlined compliance procedure for a client when it's not 100% certain that they'll qualify. There's also, I wanted to mention, one of the possible changes that is coming up to the OVDP program based upon the comments by the Commissioner are to the Streamlined Compliance Initiative. Or more specifically, what the Commissioner said was that they were going to make changes that would be helpful for individuals who are living overseas. So perhaps we'll have a little more certainty in the program. Perhaps it'll be liberalized a little bit, but we'll know pretty soon. There's certain relief within the OVDP program for accounts that don't exceed $75,000 at any time during the 8-year look-back period. That's a 12.5% penalty. There is also a 5% penalty that's available in a limited number of cases. And there's several categories. There's what I call Category 1. These are inherited accounts where the taxpayer didn't open the account, there was minimal contact with the account, and the one that usually creates a problem is that the client didn't withdraw more than $1,000 in any one year. And it has to be shown that all taxes were paid on the original principal balance going all the way back to 1991. So that also can be an issue. There's Category 2. I'm not going to spend any time on this because it almost never happens. And then we've got Category 3. These are foreign residents who meet several requirements. They have to reside in a foreign country. They have to make a good faith showing that they've complied with all their tax requirements in the country they reside in. And they have to have $10,000 or less of U.S. source income each year. Now, there's potential overlap between these Category 3 folks and people who come in under the Streamlined program. And I've been working on a flow chart which sort of tries to walk folks through this whole process. In other words, do you qualify for the Streamlined program? Do you qualify for the 5% Category 3? Do you qualify for the OVDP program? And as soon as I manage to complete that, I'm going to make that available. If any of you are interested in getting a copy when it's available, please send an email to Eva, let her know, and we'll make sure to get you a copy of that. All right. Oh, I didn't mention an important benefit for Category 3 taxpayers. They can exclude the non-financial assets from the penalty base, so that can be very helpful as well. What are the alternatives to not entering the OVDP? Well, there's always the quiet disclosure. There's also fixing things on a go-forward basis, simply filing accurate 2013 tax returns or FBARs, but not self-correcting the prior years. These are, two alternatives. You can enter the OVDP and then opt out. because you want to get the protection from criminal prosecution, but you don't believe that the 27.5% penalty is appropriate under the circumstance, and you want to argue reasonable cause or a non-willful violation, so you can do that. Of course, you can just stick your head in the sand and hope that nothing happens. We don't advise that. What are some of the potential risks of these options? Well, if the IRS finds out about the account, there's the possibility of a full-blown audit. The IRS could go into not just the foreign accounts, but any problems with domestic accounts or any other problems on the filed tax return. We've got potential penalties exceeding the value of the offshore accounts. And when you're thinking about this as to what the penalties could be, you need to pay a lot of attention to those information returns, because as I mentioned, the only way to get out of them is to show reasonable cause. And we've had situations where we've done the analysis and we've determined that even if the client can satisfy the IRS that what they did was merely negligent, because there are entities out there or trusts, when you start adding up those penalties, they can be greater than the 27.5%. Of course, there's criminal exposure. If your client is not a U.S. citizen, then if they're convicted, there's a good chance they're going to get deported after they serve their time. Of course, there are a number of potential rewards to the quiet disclosure or the fixing it on a go-forward basis. If the IRS doesn't catch up to you, there's no taxes, no penalty, no audit. Sort of tempting, but again, it's the risks are quite high. And in my opinion, the only way for a client to decide which way to go is to have someone who understands all the program and the options to go through in detail with the client their individual circumstances and try and figure out, how great is the risk that if the client is discovered, things will get extremely ugly. We are starting to run out of time. All of these slides are going to be available, as well as a transcript of this webinar, and we'll be sending out emails to all the participants so that you can get copies of the complete outline, including some topics that I haven't covered at this point. I'd like to take a final minute or two here to talk about the contest we had. There were some surprising results. Hopefully, after this webinar and after you've reviewed the slides, you would have gotten a 100% score on the contest, but the contest is now closed. One of the questions that we asked was, must ownership of foreign stocks be disclosed on an FBAR? And half of the respondents answered incorrectly. Half said true and half said false. And actually, the correct answer is it depends. Stocks must be disclosed only if it is held in a financial account. So, for example, if you own 30% of a small company, or a large company for that matter, but not listed on a stock exchange, and you just own that stock directly, you're not required to report it on an FBAR. On the other hand, if the stock is held in a brokerage account, it must be reported. So that's why the answer is it depends. Now, the rule is different for the Form 8938, where stocks must be disclosed. Another one that came up was if the IRS has served the John Doe summons on a bank, a taxpayer that has an account at that bank may no longer enter the OVDP, true or false, and 47% of the respondents thought incorrectly that the statement was true, but it's not. Until the taxpayer's name has been turned over to the IRS, they're still eligible to enter the OVDP. And finally, this one, only U.S. citizens and legal U.S. residents need to file FBAR forms. That's actually not true. If somebody is physically present in the U.S. for 183 days or more during the calendar year, or otherwise meets the substantial presence test of the Internal Revenue Code, then they're required to file FBARs. Well, let me just talk about this one because I think it's sort of important. If you tell your CPA about your foreign account, he can't tell the IRS unless you give him your permission to do so. The problem here is that although CPAs have duties of confidentiality, and they certainly can't go out on the street and tell the neighbors about your foreign account, if the IRS were to summons the accountant to appear, then there's no accountant-client privilege. The practitioner privilege of the Internal Revenue Code does not apply in a situation like this, and therefore the correct answer is false. All right, I'm going to skip this next one, and I want to announce the name of the contest winners. I don't know if either of them is on the line today, but Rebecca Leone of H&R Block got 100%, as did, and I'm going to mangle this, Shivkishan Kathari of the accounting firm of Gumbuyer Sabat. So congratulations to them. We did get a couple of questions. I don't have time to answer them at the moment, but I will try and respond by email. If any of you has any questions, feel free to email me, and don't forget, if you would like that chart that I'm working on, let us know. So thank you all for attending today.